A recent executive order signed by Donald Trump is set to fast-track the reclassification of marijuana under federal law. What this might mean for cannabis-related business and insurance coverage is the subject of a new AM Best report. We're joined today by two of the authors of that report, Associate Director David Blades and Associate Analyst Alex Winant. And Alex, starting with you, what's the underlying significance of this move at the federal level to reclassify marijuana from a Schedule I drug to the Schedule III category?
Yeah, well, the difference between Schedule I and Schedule III is that Schedule III drugs can be medically prescribed and they bear a much lower risk of abuse, and therefore these Schedule III drugs can be used in long-term medical research trials, and that helps you figure out the nuanced risks that is very important to underwriting, which wasn't available for cannabis before that. The other part of this is that kind of from the side of the cultivator, now that cannabis has been rescheduled to Schedule III, the cannabis crop is now eligible to be part of the Department of Agriculture's crop insurance subsidy program, and that's a really big deal. So now from the producer side, this subsidy allows the crop to be more standardized and kind of takes it out of this higher risk E&S category, which is what made it really expensive. And then from the consumer side, we're going to have cannabis able to be administered in these long-term institutional research studies, and that quantifies cannabis risk from the side of the consumer. So it's a two-pronged positive.
How do you think the financial sector and insurance companies are going to view this move, Alex?
I think you're going to see a lot of the legacy big banking institutions and the conventional banking systems become available to these cannabis-related businesses. Under the Schedule I, the federally illegal status, you can't buy cannabis with credit. So if this reclassification goes through, then you'll probably see that change, and that's a good example of how cannabis will become more standardized, and you'll have a more competitive and fair marketplace. And then from the insurance perspective, like I was talking about before, there was no long-term actuarial loss data. There was no comprehensive risk profile. And now that it's gone from Schedule I to Schedule III, over maybe a decade or so, they're going to be able to build up that risk profile.
David, can you describe the shape of the coverage that's currently being used by cannabis-related businesses?
Well, actually, Alex alluded to it a little bit. Traditional or standard market insurers to this point have been really hesitant to get involved with cannabis-related businesses. The federal illegality of marijuana has really been what's held them off in terms of getting involved in the marketplace. And really what's happened is that it's made excess and surplus lines insurers, they've been the ones that have been had to come to market and provide the coverage that's been there. Excess and surplus lines companies have the freedom to craft tailored products that can really address the specific needs of these cannabis-related businesses, and the companies that have actually produced products have researched the exposures, and to the extent that they are comfortable with these exposures, they've created these products and they've been able to put them out to market. Again, it's been limited or concentrated in the excess and surplus lines market, but companies have been using their freedom of form to be able to do that. Also from the standpoint that surplus lines companies do not have to file and get their rates approved ahead of time. They're also able to charge rates or charge premiums that they feel is commensurate with the risks that they are willing to provide. So I think that's really why most of the coverage to this point, again, while from a federal perspective, marijuana has been a Schedule I and still remains until it's reclassified until a Schedule III drug. That's why the coverage has been really focused and provided by surplus lines companies.
Do you think there are any other factors that is contributing to the hesitancy of national insurers to enter the space?
Well, it's funny. I think definitely the rapid pace of innovation with regards to cannabis-related businesses and products, the consumables, even the oils and the topicals, I think from the standpoint of getting comfortable with the exposures that are presented, I think, again, the rapid pace of that innovation, Alex actually mentioned earlier, you have limited claim history. And so that limited claim history, again, has produced hesitancy from an insurance company perspective in terms of really jumping into that marketplace, even for the surplus lines companies. You know, and also with the new products, you know, a lot of them, like as I mentioned, the consumables, there's a potential long-term product liability exposures that are involved with those, potentially involved with those products. And again, until there's more information about them, until there's more claim information, I think that's also played a part in the hesitancy of insurance carriers getting involved. And with limited claim history, obviously there's been limited actuarial data to inform not only from a claim standpoint, but also from an underwriting standpoint. So I think those are the factors that have led to the hesitancy of insurers, even some on the surplus line side, to really jump in and really be a little bit more aggressive in going after this. As Alex said, it'll take time. Even once the reclassification happens and the market opens up a little bit, there'll still be a runway where companies need to gain more knowledge, where there needs to be that buildup of claim history and actuarial data before the marketplace is truly robust and has, you know, a larger number of carriers willing to provide coverage.
Thank you, David. Alex?
You're welcome, John.
Thanks, John.
That was Associate Director David Blades and Associate Analyst Alex Winant. You can find the full report online at ambest.com. For AM Best TV, I'm John Weber.